Hello, I'm Mike Pepe, the president and founder of Proformex, and today we're excited to have John Mendelsohn, the president and CEO of Ashar Group. We're going to spend some time learning about life settlements. John, thanks for being here today.
Thank you.
So John, first thing, what about the name? Where does the Ashar Group name even come from?
We're very deliberate when we selected the name Ashar Group. Ashar itself was one of the 12 tribes in the Old Testament. It was the most entrepreneurial, really off the olive tree. And the name had a lot of meaning. It meant happiness and wealth, do what is right and you'll be blessed. And frankly, 15 to 20 plus years ago in this industry, it had earned a reputation of not doing a lot of those things. So we really wanted a name that kind of stood for the values of our team and the type of clients that we'd like to serve.
First thing we wanted to ask is what makes Ashar Group different from the other companies in the life settlement space?
So over 15 years ago when we established the company, the life settlement market really had a reputation of being unregulated with a lot of transparency issues, and we saw that as an opportunity really to build a client-centric type of enterprise-level solution for financial advisors and fiduciaries that really had not existed before. And we essentially wanted to be the trusted resource within the secondary market.
John, is there anything unique about the process and what you share with your buyers?
Absolutely. No different than any negotiation. We want to make sure that we control as much of the message and narrative as we can. We developed a proprietary technology platform that we use in moving policies through our process, from the valuation and longevity underwriting component all the way through the negotiation and the closing. So what we want to do is be able to share information that will always improve the client's position and share that information as efficiently as we can with buyers. And we do that through our proprietary platform that we use to negotiate life settlements and to work with all the different institutional funds.
And can you expand a little bit more about how you and your team approach the life settlement space?
We approach this space to really provide a turnkey and centralized approach to the life settlement market. So there could literally be one application that blankets the entire industry in obtaining that true market value for that policy. We have an in-house longevity and valuation team that will price policies to make sure we can maximize the value to the clients, and then all the way through the closing process. Our team has, on average, about 13 and a half years of experience. So there's virtually no planning situation that we haven't come across that's too complex for our team to address. We're comfortable, and we can certainly work with all different types of financial advisors, fiduciaries, to make sure they understand what this process will entail, so they can also feel good about documenting that process for their client.
Do you see the life settlement market in the future?
There's really been a focus on best interest in the entire financial services space. And for advisors or fiduciaries that talk about doing comprehensive planning, we just really don't understand how you cannot include life settlements in that overall planning process. So we think there'll be a lot of growth within the market itself. We do have an aging population, so every day they're looking for ways to generate more liquidity for retirement or caregiving responsibilities. There's a tremendous amount of capital that's always looking for new spaces to be deployed, and the life settlement market really offers that opportunity. The studies have estimated that this market will grow up to as much as $250 billion over the next 10 years, and within that, we're talking about billions of dollars being generated to consumers on an annual basis. So we are really bullish, and we expect this market will continue to have the type of growth that it has in the past 5 years.
So talking about the process and supporting advisors, when is the right time to look at a life settlement?
Typically, the right time to look at a life settlement is when the original need from the policy no longer exists. So the client has essentially transitioned out of the original purpose that the policy was put in place. Maybe they had an estate planning need, and now with changes in the exemption, they just don't need as much coverage as they did when the policy was originally issued. Maybe they had life insurance put in place for business planning purposes, for a buy-sell or key executive insurance, and they're selling their business or retiring. There's so many other reasons that a person might not need that policy anymore. Maybe it was put in place for some of those types of reasons for family protection, and the God forbid happened. Maybe the wife predeceased the husband or the children predeceased the parents, and they just don't need that coverage anymore. But typically the most common reason is that there's increased longevity and the client has outlived the original need. However, they're much older now. Maybe they're living into their late 80s and even 90s, and they didn't do the planning in place years ago to have that type of liquidity available for lifestyle or caregiving requirements. So now they can reposition their life insurance to fund some of those current needs, many times taking pressure off the second generation or others.
In the past, when policyholders no longer needed their coverage, they would either surrender it or just cash it out for the cash in it. What do you see with these new best interest standards? How's that going to affect the positioning of life settlements?
This is really just one more other legal right or legal option that the client can explore. It may or may not make sense to even sell the policy, but certainly know what the policy is worth. And if there are other options that might solve today's problems, is a great example of ways to help clients. Another way is by looking at all the assets on the balance sheet. And why would they consider selling maybe a second home or a family heirloom, something such as that, when they have the ability to take this life insurance that might have already served its purpose, appraise and monetize that to solve today's needs? So if they are looking at different types of comprehensive planning and they're looking at all the assets on the books, most advisors, if they omitted the real estate portfolio or the art collection from an estate plan, they'd say that, gosh, I might have some liability for doing that. Well, life insurance is one of the largest unmanaged assets that a client owns. So now they have the ability, and many believe the obligation, to also have those policy appraised or valued and considered for a life settlement when the need doesn't exist.
How is it regulated? Is it regulated state by state? What are you seeing out there, and what are the effects with state regulations?
Now, the life settlement market is regulated in 90% of the states, so it's virtually impossible to think about this market as the Wild West or unregulated as it was 15 to 20 years ago. Every state insurance department regulates life settlements versus a federal regulation. And that regulation is based on the state of the policy owner. So if the insured lives in one state but the trust is domiciled in another, the ownership and the regulation is predicated on the state of the policy owner. So if the trust is domiciled in Delaware, it becomes a Delaware transaction with all the applicable states and
Obviously, with life insurance, there's many different product types. What are the ideal product types that fit the mold for potential life settlements?
All types of policies can qualify, including term insurance, preferably term that's still convertible. However, the most purchased policy and type of policy being purchased are universal life contracts or some version of that, guaranteed universal life contracts that really can minimize the cost of insurance risk, IUL, VUL, and survivorship policies as well. Whole life is typically the least purchased type of policy due to the higher cash value and loans. The capital markets that focus on this industry, they have billions to spend, so they're really not looking to purchase cash with cash. So policies where the insured has outlived the coverage or the cash values are very low, some might even consider those policies to be broken policies. They're thinly funded and now escalated premiums are due. Those actually might be the ideal contract to look at for a life settlement. So if a policy has not been managed properly over the years, that might be an opportunity to consider if a life settlement makes sense. And once again, just because a policy has value does not mean they have to sell it in the life settlement market. It might make sense to keep that policy or restructure it.
And then, when you purchase life insurance, you're trying to get the best underwriting class possible to keep the premiums down. With life settlements, how does life expectancy affect the offers?
Well, the life settlement calculations and modeling that takes place to determine the value of a policy is really not that different than other financial transactions that the consumer might be involved in. There are two main factors are typically how much do you pay and how long do you project to pay it, no different than if you're issuing a policy. Well, in the life settlement market, the risk factor that really weighs heavily on that is the life expectancy. So if an insured has a life expectancy of 15 to 20 years versus a life expectancy of 5 to 7 years, there's typically going to be a higher offer on that policy with a lower life expectancy. That's less risk to the institutional fund compared to a policy that has a much longer hold period. So if they have to escrow out premiums for 15 to 20 years, obviously that's that's going to cost them more time and money versus a lower life expectancy. So ideally, when looking at a life settlement, the goal is to extract as many of the different health issues, understand the life expectancy underwriting, so you can best position the policy to have the highest outcome for the client. And that lower premium that you have as well will relate into that, because that gives you a little bit more flexibility when there's longer life expectancies.
And what's the process and timing? If you had a client that found a policy they no longer need, can't afford, fit the life expectancy profile, what is the process and the timing from beginning to the end?
Sure. So from a timing standpoint, you can really determine in week one if it's really worth moving forward or not, what that reasonable range of value could look like, and if it makes sense for the planning for the family, the adult children, the business, whoever the entity is that owns the policy and has to commit to those future premium payments. So you can determine that in week one. The overall process is similar to selling a home, and it will take anywhere from 2 to 4 months to go through that entire underwriting, negotiation, and contracting process itself.
John, is there anything unique about the process and what you share with your buyers?
Absolutely. No different than any negotiation. We want to make sure that we control as much of the message and narrative as we can. We developed a proprietary technology platform that we use in moving policies through our process, from the valuation and longevity underwriting component all the way through the negotiation and the closing. So what we want to do is to be able to share information that will always improve the client's position and share that information as efficiently as we can with buyers. And we do that through our proprietary platform that we use to negotiate life settlements and to work with all the different institutional funds.
Then the last question I have is, you get a formal offer, the client accepts it. What is the taxation on the value that you made for the sale of the policy?
So at the end of 2017, there was a revised revenue ruling 2009-13, and this had a huge impact to the life settlement space. It at that point started to treat a policy similar to a surrender. There would be zero tax up to the basis or the premiums paid into the policy. From the basis to the surrender value, that would be treated as ordinary income. Everything above that would be a long-term capital gain. So this really proved that life insurance was a capital asset and should be treated as such. You could appraise it, you could monetize it, you could transfer it, and really do what's in the best interest of the client while working with the advisory team that is providing advice. We're really going to provide that data point and then work with their trusted advisors to help go down any of those discussions that would involve tax planning. That's not something that we provide, but we do work with advisors, and we'll provide them what they need so they can make the best decisions for the client.
One of the things I wanted to bring up, with advisors, there's multiple ways and companies out there that are doing sales for the advisors, but how can an advisor be misled? And what is your recommendation for advisors looking to take a life settlement opportunity to the market?
So this is one of the most common questions that we've had, and especially within the fiduciary space, because they want to be so careful as to always look out for the best interest of the client. So they do really want to understand how could they be misled in this transaction when this is maybe not their core business. However, in certain situations, a life settlement might make sense. Well, the most common way that an advisor could be misled is by not understanding who is truly and dutifully representing them within the life settlement market. No different than any other asset sale, you have a buyer's representative and a seller's representative, and understanding all the intricacies around that, understanding how to do the valuation work, how to model it out, how to understand the longevity, and how to best position that policy is critical in making sure that you can deliver the most competitive offer to the client anytime they're going to approach a life settlement. Well, today's world is really filled with a lot of marketing and information all over, from the internet to direct to consumer advertising and all different forms of media. And many of those making those marketing promotions, they're not necessarily disclosing that they don't represent the client. They represent investors only. They have one responsibility and one responsibility owner. One responsibility. They are not malicious, but they're like any investor who's trying to generate the best rate of return they can. So what's critical when approaching the life settlement space is to make sure that you're only sharing information with those that have 100% fiduciary responsibility to you as the policy owner and to the advisory team. What you don't want to do and what you'd like to avoid is sharing information that could essentially harm the future outcome for your client. No different than if you were selling any other asset or any other piece of property. What you don't want to do is to share information that would not be in the client's best interest. So what we're encouraging advisors to do is always ask right up front, do you have a responsibility to the investor or to the client? Are you licensed to represent the buyer, or are you 100% licensed to represent the consumer and the advisory team? That is typically the most often way that advisors are misled in today's market.
Great. John, thanks for your insight. We appreciate your time today, and talk soon.